Federal Reserve has just signaled a huge shift in its strategy. We're talking about rate cuts. Yeah, after almost 2 years of really aggressive hikes to fight inflation, the Fed is now officially changing course.
But what does a pivot like this actually mean? How does a decision made in a boardroom in Washington, D.C. really affect the economy, businesses, the markets, and maybe the most important part, your own life?
So let's break it all down. In this explainer, we're going to cover the Fed's big shift. Then we'll talk about what it means to hit the growth button. After that, we'll get into the direct impact on your wallet, how it helps out businesses and jobs, and finally, how the financial markets react to all this.
All right, first up, let's really unpack what the Fed announced and why it's such a big deal.
Okay, so on December 11th, the Federal Reserve sent a really clear signal that rate cuts are on the horizon. Now, to get why this matters so much, you have to understand the context. This announcement marks the end of one of the fastest, most aggressive tightening cycles we've seen in decades, a time when the Fed deliberately made borrowing money more and more expensive to cool down the economy. And now, well, it looks like that chapter is closing.
So why the change of heart all of a sudden? Well, in the Fed's view, their tough love approach actually worked. Inflation is finally cooling off, and the economy is starting to stabilize. But here's the thing, it's a super delicate balancing act. If you act too soon, you could reignite that same inflation you just fought so hard to bring down. So they feel the economy is finally ready for a gentler touch, one that's all about supporting growth, not holding it back.
And that brings us right to the core idea of this whole shift, hitting what you could call the growth button. So let's dig into why rate cuts are the Fed's #1 tool for doing exactly that.
At its heart, an interest rate cut is, well, it's pretty much what it sounds like. It's when the central bank takes direct action to make borrowing money cheaper for everyone across the entire economy. And the goal is really simple. You want to encourage people and companies to spend more and invest more, because that's what fuels economic activity.
And this is the perfect way to think about it. If the economy starts to slow down, or if demand just looks a little weak, rate cuts act like a shot of adrenaline to help it get its momentum back. It's literally the Fed's way of hitting a big green go button for growth.
Okay, so that's all the high-level theory. But let's bring this down to earth. How does this policy decision actually trickle down and end up in your wallet?
This is the question that really matters, right? How does a meeting at the Fed actually translate into real-world changes for people like you and me?
Well, the impact pretty much unfolds in 3 main steps. First, and most obviously, loans get cheaper. We're talking mortgages, car loans, even the interest on your credit card. All of that tends to go down. Second, credit itself just becomes easier to get. When it's cheaper for banks to lend money, they're usually a lot more willing to do it. And third, when borrowing is easier and cheaper, well, people tend to spend more, and that boost in spending helps the whole economy.
And to put a real number on it, just look at mortgages. A drop of only 1% in interest rates might not sound like a huge deal, but stretch that out over the 30-year life of a home loan, that can literally save a homeowner thousands and thousands of dollars. I mean, that's a real, tangible impact.
And this effect totally supercharges the housing market. Lower mortgage rates mean more people can afford to buy homes, which pushes demand way up. This creates brand new opportunities for buyers who might have been priced out before. And at the same time, it gives sellers more pricing power. It's a ripple effect that helps everyone from construction crews to real estate agents. Now, moving beyond our personal finances, these rate cuts also provide a major boost for businesses and the job market. Let's take a look at how that works. So how exactly does this help, say, a local shop owner, or a new startup, or even a giant corporation?
Truth is, businesses are often the biggest winners here. For one thing, they get access to cheaper financing, which lets them expand, upgrade their equipment, or launch new products. And as these businesses grow, they naturally need more workers, so these cuts directly lead to job creation. And finally, if a company already has debt, lower interest rates mean their payments go down, which improves their cash flow and frees up money to invest elsewhere. Of course, there's one group that hangs on every single word the Fed says: the financial markets. So let's look at that ripple effect.
Markets almost always see rate cuts as good news, and you can see why right here. When rates get cut, stocks often go up because investors are betting on higher future profits. Bond yields fall, which makes existing bonds with higher payouts more valuable. And overall, what we call risk appetite just goes way up. Investors feel more confident and are more willing to put their money into growth assets. That's exactly why you so often see a big market rally after a Fed announcement like this.
And this isn't just an American story, not by a long shot.
The Fed is without a doubt the world's most influential financial institution. So when the U.S. lowers its interest rates, it actually increases global liquidity. Basically, it makes more U.S. dollars available all over the world. This helps emerging markets, it stabilizes currencies, and it makes international borrowing cheaper for everyone. A decision by the Fed really does echo across the globe.
So what's the bottom line here?
Well, this signal from the Fed points toward a future with cheaper borrowing for all of us, stronger growth for businesses, and much more optimistic market, a real boost for both jobs and housing, and even greater stability for the global economy.
So if you remember one thing, remember this. A rate cut isn't just a financial adjustment. It's a powerful signal. It's the Federal Reserve telling the entire world that the priority is no longer restraint, but a confident shift towards growth.
The signal has been sent. The Fed's finger is hovering right over that growth button. So, the big question it leaves all of us with is, what happens next?